Have you ever felt like you're playing a game where the rules keep changing in the middle of the level? You study the map, you grind, you collect coins, and then suddenly, the difficulty spikes. One year, you're saving for a car. The next year, that same car costs 20% more. Your rent jumps. Groceries cost more. Your portfolio turns red. You didn't suddenly become bad with money. You didn't get lazier. You didn't get dumber. The map changed. And most people are trying to win the game without ever seeing the full map. Today, I'm going to show you the map. Not to make you an academic economist, not to impress you with formulas, but so you stop feeling like the system is randomly attacking you. Personal finance advice, budgeting, saving, discipline, is microeconomics. That's your little campfire in the woods. Macroeconomics is the weather system above that forest. It's the hurricane, the forest fire, the volcanic eruption. If you only stare at your campfire, you'll never understand why the wind keeps blowing it out. And investing without macro awareness is like sailing without checking the wind. You might move, but you won't control the direction. The economy is not a static building. It's a flow. Imagine a simple loop. You work for a company. They pay you wages. You spend those wages at a store. The store pays its employees. They spend again. This is the circular flow of income. Your spending is someone else's income. Their spending becomes someone else's income. When everyone feels confident, the loop spins quickly. We call that expansion. Businesses hire, profits rise, asset prices climb. When people get scared and hoard cash, the loop slows. We call that a recession. Businesses cut costs, layoffs begin, markets fall. Macroeconomics is basically standing over this giant engine with a pressure gauge, trying to figure out if it's overheating or about to stall. Now let's identify the players inside this engine. Households, you. You own the labor. Firms, they rent your labor to produce goods and services. The government, the referee and sometimes the janitor. The rest of the world, other players trading with you. Everything flows between them. And once you see that flow, the chaos starts making sense. How do we know if the economy is winning? We look at GDP, Gross Domestic Product. Think of GDP as the total experience points a country earns in 1 year. The formula looks complex, but for Stickman, it's simple. GDP equals consumption plus investment plus government spending plus exports minus imports. Consumption. What households buy? Investment. What businesses spend to grow? Government spending. Infrastructure, salaries, defense. Net exports. Are we selling more than we're buying? But here's the trap. If GDP rises only because prices rise, that's nominal GDP. It's a fake level up. We care about real GDP, which removes inflation. If real GDP falls for 2 consecutive quarters, that's typically considered a recession. And that's when layoffs start appearing on the screen. But here's why this matters for you. When GDP slows, earnings slow. When earnings slow, valuations compress. When valuations compress, markets fall. GDP is not abstract. It's directly connected to your portfolio. Why are some countries rich while others stay stuck? Productivity. Imagine 2 stickmen digging. One uses his hands. One uses a shovel. The shovel wins. Now imagine one uses an excavator. Massive difference. Productivity is output per hour worked. In the long run, productivity growth is the only sustainable way to increase living standards. Without productivity, the only way to grow is to work longer hours. But there are only 24 hours in a day. Technology, education, innovation, these are multipliers. As an investor, you want exposure to economies and companies building excavators, not just digging harder. Most people think inflation means high prices, Wrong. High prices are the symptom. Inflation is the devaluation of purchasing power. If you worked 8 hours to earn $100 last year, and today that $100 buys 20% less, nearly 2 hours of your labor just disappeared. That's inflation. Now here's something most people miss. Official inflation is an average. The CPI tracks a basket of goods. But your personal inflation depends on what you buy. If housing and healthcare rise faster than average, your inflation is higher than reported. The 4 forces of inflation. Demand pull. Too many buyers chasing limited goods. Cost push. Production costs rise. Monetary expansion. Too much money supply growth. Expectations. People expect inflation, so they act in ways that create it. Inflation is economic, but it's also psychological. If inflation is a thief, deflation is a ghost town. Prices fall. Sounds good? Imagine you know a car will be cheaper next month. Would you buy today? No. You wait. Everyone waits. Consumption collapses. Businesses fail. Unemployment rises. The loop dies. Deflation kills urgency, and economies run on urgency. For investors, deflation environments can crush corporate profits and asset prices. Now the boss level, stagflation. No growth, high unemployment, rising inflation. It's like your character is frozen, but your health bar keeps draining. This is one of the hardest environments for markets, and policymakers have limited tools to fix it. You are part of the labor market. Unemployment isn't just data. It's rent payments. It's mortgages. It's families. There are 3 types. Frictional. You're between jobs. Healthy. Structural. Your skills no longer match the market. Dangerous long-term. Cyclical. Recession destroyed demand. Temporary but painful. Now here's why investors care. Low unemployment leads to wage pressure, leads to inflation risk. High unemployment leads to rate cuts, likely leads to stimulus incoming. The labor market drives central bank decisions. And central bank decisions move markets. Most people think banks lend out deposits. In modern banking, loans create deposits. When Stickman takes a mortgage, new money is created digitally. Credit expansion fuels growth. But here's the danger. If banks get scared and stop lending, money creation slows. Liquidity disappears. Credit crunch begins. And liquidity is oxygen for markets. When oxygen disappears, crashes accelerate. Before we continue, understand this. Every major bull market and crash connects back to policy. First, the government. This is fiscal policy. Fiscal policy works through taxes and spending. When governments spend more than they collect in taxes, they run deficits. When deficits continue year after year, debt grows. And if that debt grows faster than the economy, faster than GDP, borrowing costs eventually rise. And when borrowing costs rise, valuations come under pressure. Now the second force, the central bank. This is monetary policy. The central bank controls interest rates. When rates are low, money is cheap. When money is cheap, borrowing increases. Risk assets rally. Stocks rise. Speculation expands. But when rates are high, money becomes expensive. Borrowing slows. Speculation dies. The central bank also has another powerful tool, quantitative easing. QE is the emergency liquidity button. It injects money into the financial system. Historically, aggressive QE environments fuel asset rallies. Because liquidity drives markets more than headlines do. This is not financial advice. This is education so you understand the map. No country operates alone. Currencies are trust indicators. Floating exchange rates move freely. Fixed rates require reserves and discipline. The trilemma says you can't have fixed exchange rate, free capital movement, independent monetary policy. Pick 2. Try all 3. Markets will break the system. The carry trade amplifies volatility. Borrow in low-rate currency. Invest in high-rate currency. It works until panic hits. Then unwinding causes market earthquakes. When emerging markets crack, global markets feel it. Normally, long-term rates are higher than short-term rates. But when short-term rates rise above long-term rates, that's inversion. It signals the bond market expects slowdown and future rate cuts. Historically, yield curve inversion has preceded most recessions. When you see inversion, don't panic. But don't ignore it either. The map is warning you. Debt is a claim on future taxpayers. Domestic debt can be inflated away. Foreign debt is dangerous. If your currency collapses, foreign debt doubles in local terms. That's how crises begin. CDS spreads measure default risk. When they spike, global investors are nervous. And when capital flees, volatility follows. Macro is the wind behind your portfolio. When inflation starts rising, central banks respond by raising interest rates. And when rates rise, valuations tend to compress. When liquidity expands in the system, risk assets usually rally. More money flowing means more fuel for markets. When the yield curve inverts, it's often a signal that defensive positioning becomes logical. It suggests stress building beneath the surface. And when recession panic hits the headlines, that fear can create long-term opportunity for disciplined investors. Most investors lose because they react emotionally. They chase at peaks. They panic at bottoms. The economy is not random. It is a system of flows and incentives. Once you see the system, you stop feeling attacked. You start positioning strategically. The game is not rigged. It's complex. Macroeconomics is the weather map. You cannot stop storms, but you can adjust your sails. When others panic because they never learned the map, you stay calm. Stay aware, stay rational, stay patient, and let compounding do its quiet work. I'm Stickman. Now you've seen the full map. The next move is yours. And if this video helped you see the economy more clearly, hit the like button and subscribe for more simple Stickman macro breakdowns. This is Stickman Invests. See the map, stay disciplined, build long-term wealth. Thanks for watching, and I'll see you in the next video.